You finally did it. After years of stacking, years of watching the charts, and years of being called crazy by friends, family, and the people on financial TV, you held your silver through the dips. You held it through the manipulation claims. You held it through the ridicule. And now here you are in 2026, sitting on massive gains. Silver had a huge run. It shocked most analysts. It outperformed what many people expected from precious metals. And now you may be looking at your stack and thinking, maybe this is the time. Maybe I should cash out. Maybe I should buy the house, pay off the car, or finally take that trip I have been putting off for years. But before you call your dealer and before you log into your brokerage account and press sell, stop. Because what I am about to tell you can completely change the way you look at your silver profits. A lot of silver investors think the hard part is buying low and selling high, but that is not the whole story. The part many people miss is what happens after the sale. The IRS may take far more of your silver profits than you expect, not 15%, not 20%, in some cases up to 28%. And if you do not understand why, you could hand over a huge chunk of the wealth you spent years building. Welcome to Bridgeport Finance Channel. Let's break this down. Here is the part that many people in the precious metals world do not want to talk about. According to IRS guidance, net capital gains from selling collectibles, things like coins or art, can be taxed at a maximum rate of 28%. Let me say that another way in simple English. For tax purposes, the government often does not treat precious metals like regular stocks. Under U.S. tax rules, many forms of physical precious metals are classified as collectibles. That means your silver bars, silver rounds, American Eagles, and junk silver may not get the same tax treatment as shares of Apple or an S&P 500 fund. In the eyes of the IRS, many of those metals are placed in a category closer to things like rare coins, artwork, antique furniture, or wine collections. And that one classification changes the entire tax equation. Let's run the numbers, because this is where it gets painful. Imagine you bought 100 ounces of silver back in 2024 at $28 an ounce. That means you invested $2,800. Now let's say silver is trading at $72 an ounce. Your 100 ounces are now worth $7,200. That gives you a profit of $4,400. On paper, that feels amazing. You more than doubled your money. But now comes the part nobody likes talking about. If that same $4,400 gain came from a stock you held for more than a year, many investors would expect to pay the standard long-term capital gains rate, often around 15% depending on taxable income. On a gain like that, the tax bill might be around $660 and you keep the rest. But because your gain came from silver, which may be treated as a collectible, your tax rate could be much higher. At the maximum collectible rate of 28%, that same $4,400 gain could create a tax bill of roughly $1,230. That is hundreds of dollars more gone instantly. And remember, that example is only 100 ounces. Scale that up to 1,000 ounces, and now you are talking about thousands of extra dollars lost to taxes. Scale it to 10,000 ounces, and the number becomes serious money. This is why the collectible tax rate is such a silent wealth destroyer. Many stackers do not see it coming until it is too late. Now let's deal with something that confuses a lot of investors: short-term versus long-term gains. This matters a lot. The 28% collectible rate generally applies to long-term gains, meaning you held the asset for more than 1 year. But if you bought silver less than a year ago and sell it for a profit today, that gain is generally taxed as ordinary income. Ordinary income simply means it gets taxed like money from your job or business, based on your tax bracket. And for high earners, that rate can go much higher than 28%. In some cases, it can go as high as 37%. Think about that. If you bought silver 9 months ago and sell it now, the government could take 37 cents out of every dollar of profit. You thought you were protecting your wealth from inflation, and suddenly your tax bill becomes the real shock. Now here is where things get even more misleading, because this next trap catches even experienced investors. A lot of people think, fine, I will just avoid physical silver and buy a silver ETF instead. It trades like a stock, it sits in my brokerage account, so it must be taxed like a stock. Not necessarily. Many popular precious metals ETFs are structured as grant or trusts that hold physical metal. For tax purposes, the IRS may treat you as if you personally own a share of that underlying metal. So even though you bought it digitally, never touched a silver bar, and never stored anything in a safe, the IRS may still treat that gain like a collectible gain. That means buying silver through certain ETFs does not automatically protect you from collectible tax treatment. And here's the part that makes this worse. Your tax software may not catch it correctly. A lot of people import their 1099-B, click through the prompts, and assume everything is fine. But some software may default to the standard long-term capital gains treatment unless you review the details carefully, so you might file your return thinking you owe 15%, when the IRS later says the correct rate was higher. And if that happens, you may not just owe more tax, you could also owe penalties and interest. Now, to be fair, there is an important detail here. The 28% rate is a ceiling, not a blanket rate for everyone. That means not every silver investor automatically pays 28%. If your ordinary income tax bracket is lower, your collectible gain could be taxed at that lower rate instead. So if you are in a 22% bracket, you may pay 22%. If you are in a 24% bracket, you may pay 24%. The 28% cap mainly hits people whose tax bracket would otherwise be higher. But here is still the problem. For many middle-income investors, long-term stock gains might have been taxed at a lower capital gains rate, often 15%, while their silver gains can end up taxed much higher. That gap matters. The difference between 15% and 28% can wipe out thousands of dollars on a position that took years to build. Now let's talk about reporting, because there is a dangerous myth in the stacking community. The myth is this: if I keep my sale small enough, the IRS will never know. That is a fantasy, and if you believe it, you can get yourself into serious legal trouble. There are reporting triggers that dealers must follow. For example, dealers may have to file Form 1099-B when certain thresholds are hit, such as large sales of silver bars or rounds. For junk silver, there are separate thresholds, and if a cash payment crosses certain levels, that can trigger Form 8300 reporting requirements. But here's the critical point most people miss. Those thresholds affect what the dealer has to report. They do not erase your legal duty to report your own gains. Even if your transaction does not trigger a 1099-B, you are still required to report taxable profits on your tax return. That obligation does not disappear just because no form showed up in the mail. The IRS does not need a dealer form to start asking questions. They can look at bank deposits, they can review records, they can compare information across different sources, and trying to break transactions into smaller pieces just to avoid reporting thresholds is called structuring. That is a federal crime. Do not do it. So at this point, you may be thinking, this sounds like a disaster. Is there any legal way to protect myself? Yes, there are legal strategies. And this part is important because this is where planning matters. Strategy number 1, use a self-directed IRA. The collectible capital gains issue generally applies to precious metals held outside retirement accounts. A self-directed IRA can change that. In a traditional self-directed IRA, your gains can grow tax-deferred, which means you do not pay tax right away. In a Roth self-directed IRA, qualified withdrawals can potentially be tax-free. That means if silver appreciates over many years inside a Roth structure, you may avoid capital gains tax entirely on those qualified withdrawals. That is a massive difference. But there is a catch. The metal has to be held according to IRS rules, usually in an approved depository. You generally cannot just buy silver for an IRA and keep it in your closet at home. Strategy number 2, tax loss harvesting. This is a simple idea with powerful results. If you have losses in other investments, like stocks or crypto, those losses can potentially offset your capital gains. So if you made a large gain on silver, but also have a losing position somewhere else, selling that losing asset may reduce your net taxable gain. For example, a $40,000 silver gain minus a $30,000 capital loss leaves you with a $10,000 net taxable gain. That can dramatically reduce your tax bill. Strategy number 3, maximize your cost basis. Your taxable gain is not always just the difference between the purchase price and the sale price. Your cost basis can include legitimate costs tied to acquiring and holding the silver, such as dealer premiums, shipping, insurance, safe deposit box fees, and possibly appraisal-related costs when appropriate. Every valid dollar added to your basis can reduce your taxable gain. That is why records matter. Keep your receipts, keep your invoices, keep your documentation, because when tax time comes, paperwork is power. Strategy number 4, consider mining stocks instead of physical metal. This one is important for people who want silver exposure but also care about tax efficiency. Mining stocks are not the same as physical precious metals. In general, they are not classified as collectibles. That means gains on mining shares may fall under standard capital gains rules rather than collectible tax rules. So instead of holding physical silver, some investors choose companies tied to silver production or royalties. The trade-off is obvious. You give up the satisfaction and security of owning physical metal, but you may gain a more favorable tax treatment. For large positions, that trade-off can matter a lot. And strategy number 5, the step up in basis for inherited assets. This is one of the most powerful wealth transfer tools in the tax code. When heirs inherit assets, those assets often receive a step up in basis. In simple terms, that means the tax basis is reset to the market value at the time of death. So if your silver appreciated significantly during your lifetime, that built-in gain may not carry over the same way to your heirs. That can dramatically reduce future taxable gains. For families thinking long-term, this is not a small detail. It can be a major planning advantage. Now, there is one more layer most people overlook. Sometimes the real tax rate can be even higher than 28%. Why? Because high earners may also face the net investment income tax, which can add another 3.8%. And then there is state tax. Depending on where you live, your state may also tax those gains, and some states do not offer any special treatment at all. So for some investors, the real combined tax cost is not just 28%. It could be 31.8%. It could be 35%. It could even go higher when state tax is added. That is why understanding the tax architecture matters before you sell, not after. Because once the sale is done, the tax bill is already on its way. And that brings us back to the big picture. Silver may still have major upside. Big institutions and analysts continue to make bullish projections. The excitement is real. The opportunity is real. But none of that changes the tax rules. The silver is yours. You earned it. You held through the fear, the doubt, and the volatility. But the IRS plays by a different rulebook than the stock market crowd. And if you do not understand that rulebook, your victory can turn into a tax surprise that takes a painful bite out of your gains. So before you sell, plan. Know how your silver is taxed. Know whether your ETF is treated like physical metal. Know your holding period. Know your cost basis. Know your options. Because the smartest silver investor is not just the one who buys before the breakout. It is the one who keeps more of the profit after the sale. If this video helped you, hit like button. If you know someone stacking silver who needs to hear this, share it with them. And subscribe to Bridgeport Finance channel so you do not get blindsided by the financial details nobody else wants to talk about. I will see you in the next one.